Good morning and a warm welcome to the third of our webinars during these exceptional times. As we continue through lockdown, we thought it might be helpful to cover a broad range of possible investments clients may be considering in these times, and this will be reflected in some of the content of the presentation. Just by way of an introduction, I'm Steve McPhillips, Dentons Technical Sales Director, and part of my role is to provide technical help and material for advisors and their support staff. And a warm welcome back to those who listened to our previous webinars. If you missed these, they're available through our website, and hopefully all three will be helpful to you in some way. As before, my colleagues from our national sales team are listening in. I'll point them out to you later on in the webinar. There's a Q&A facility this morning, so please use that to submit any questions, and we'll address these offline after the session. Actually, we'll do a sweep up of all three webinar Q&As afterwards, so you can see the types of questions that come up and the answers we've been able to give to them. So let's make a start then. We do have some particular learning objectives, which I hope the content will cover off this morning, and we'll revisit them at the end as usual. We're concentrating this morning on a broad range of potential investments within self-invested pensions, SIPP and SSAS, and some potential reasons why clients might want to make these investments. We're also looking at some considerations advisors might have when selecting a provider, including the provider's own investment due diligence processes. Our agenda is set out here today, as you can see, and it's focused on investments within bespoke SIPP and SSAS and the due diligence considerations around these. We'll also cover a recent High Court judgment in the context of due diligence on SIPP and SSAS providers. Just a reminder that the Q&A will deal with any questions, hopefully, that you have as we go through the presentation. So just a very brief introduction to Dentons, in case you've not heard from us before. We're a bespoke SIPP and SSAS provider. We've got specific expertise in commercial property and non-standard investments, and we provide tailored services for market segments that the big providers don't seem to serve very well. We've got long-serving and experienced members of staff. We're profitable, and we more than meet our CAPAD requirements. And those in themselves might be due diligence factors you already consider when looking at SIPP providers. We're commercial property specialists, as I said. We've got over 2,600 commercial properties. And it's our history and experience that enables us to cover the subjects we're covering this morning. So enough about Dentons. Let's move on then to some broad investment or asset classes. The clients can invest in a whole range of different things within self-invested pensions, or in fact outside of self-invested pensions, as you know. They could be looking at direct commercial property investment. They could be looking at quoted stocks and shares or unquoted equities. They might be looking at gilts or cash, or loans to companies as opposed to loans to businesses, or they might even be looking at commodities. In the context of self-invested pensions here, in relation to commodities, we're thinking about investment grade gold bullion. So these are some examples of broad investment classes that we see within SIPP and SSAS, and each has characteristics that distinguish them from each other. And it's those characteristics that can lead to SIPP and SSAS clients in choosing to invest in or indeed avoid certain ones. So we'll look at some of these categories during the presentation, including reasons why clients might want to invest in each. Let's look at commercial property first then. So direct commercial property investment and its characteristics. We covered the specific advantages and disadvantages of property investment in the previous webinar, so we won't actually revisit those this morning. But as I said earlier, they're available on the first webinar on our website. So let's look at some characteristics of direct property investment. Well, it's considered as a real asset, and by that I mean its value tends to keep pace with or exceed price inflation. It's also a tangible investment or tangible asset, in as much as bricks and mortar can be seen and touched, and that actually appeals to some clients. It's viewed by some as relatively stable compared with some other asset classes. The income stream can be quantifiable and known in advance, and often it's a rising income stream. If it's a standard institutional type lease where the rent reviews are upwards only, then obviously there's a provision there for rent to go up, never go down, but potentially go up. And that can often be known in advance of buying a property. In terms of overall marketability, generally wide investment market for commercial property. It depends on the nature and location of the property, obviously, and each property is unique, but generally wide market for commercial property. If we think in terms of liquidity, it can be viewed as an illiquid investment, but if it's put up at auction, potentially it can be sold within 30 days to deal with liquidity, but generally viewed as relatively illiquid. And it can be viewed by some as a means of diversifying from other types of asset classes out there. And it's also viewed by some as a kind of halfway house between bonds and shares when we look at risk relative to return. Some people view it as a halfway house between the two. So that's direct commercial property investment. Let's now have a look at equities and their characteristics. Well, again, equities, like property, can be viewed as a real asset. It's a tangible asset. Share certificates can be seen and touched. And in terms of volatility, it can be a more volatile asset class than, say, commercial property, and more prone to market fluctuations. And in fact, we've just got to look at the FTSE 100 this year alone, or in fact, this week alone, to see the level of volatility that can happen with equities. As far as income stream is concerned, it's generally variable, and the dividend policy of the company will vary depending on trading conditions and company profitability. And thinking about the current conditions, again, the current environment is challenging for many businesses in terms of profitability and dividend forecasts. Overall, marketability is wide, obviously, for quoted equities, but could be particularly narrow or restricted for unquoted shares. In fact, some unquoted shares may not be accessible to investors. For example, a special purpose vehicle with a restricted shareholder agreement in place wouldn't be as accessible to outside investors. And a lack of marketability for unquoted shares can cause liquidity issues within SIPP and SSAS. And this is starting to feed into some of the due diligence considerations that we'll move on to later in the webinar. Equities could be seen as a diversification from other asset classes as well, depending on what the client's overall portfolio looks like. Let's then look at loans to companies then, and some of their characteristics. And we'll start off with a high level look at these, rather than drilling down at this point in time. Well, fixed rate loans could be viewed as a monetary asset in as much that they may not keep pace with inflation. And that depends on the rate and obviously economic conditions in the background. Depending on the borrower and loan terms, they may be seen as a high risk investment, but generally higher returns would be expected. The risk and underlying features of loans to companies depends, and it varies on the strength of the borrower, any loan security, and the borrower's ability to repay. As far as income streams concerned, well, if it's a SSAS loan to employer, we know that at least quarterly capital interest payments must be made. So those are known and they can be planned for. They can be paid for cash flow, but be variable in other circumstances if it's not a SSAS loan to employer where capital interest repayments are made at least quarterly. In terms of marketability, there's little, no or very limited secondary market for them, so that has a bearing on people's views on whether to invest in these or not. And in relation to liquidity, it could be viewed as a generally illiquid investment if it's not repayable on demand. So the repayment terms will dictate that. And it also depends on the borrower's ability to repay as well. And it may depend on any underlying security. If the loan's being made by a SIPP or SSAS, loans can only be made to companies that are not connected with a SIPP or SSAS member. And there's more to follow on that shortly when we start to drill down into the specifics of loans to companies. So we've looked at some broad investment examples. Let's now look at reasons why investors might wish to invest in these or actually avoid them. Well, some reasons why people might wish to make a particular investment might be for capital appreciation purposes. It might be to achieve attractive annual investment returns. In fact, sometimes the investment returns look more than attractive, almost too good to be true, in some things that are put to providers. But that's another reason why clients will be attracted to them. It might be for diversification purposes compared to their other assets across the rest of the portfolio. It might be to dovetail their own personal and company financial planning. For example, if a SIPP or SSAS owned property is leased to the client's business. It might be just as an alternative to mainstream investment and not following the herd. It might be as an alternative to cash, or it might indeed be to provide cash for business or personal use. And that might be particularly helpful where the vendor of the asset is the client or the client's company, because selling, for example, a commercial property to a SIPP or SSAS can release cash to the individual or the client's company, and that might be particularly helpful during the current crisis, as we covered in our first webinar. Clearly, the investment motivations will vary from person to person, but the investment could be made for any of the reasons that we've just discussed. What I would say is that responsible providers will aim to ensure that the investment stands up on its own merits and it's not being made simply for ulterior motives which benefit the member or a connected party. Is there some other reason for the investment being made? For example, is the investment merely a route to some outcome for the member, some other outcome, for example, a seat on the board of directors, being contingent on the member acquiring shares in the company? Or is it merely to stop land adjacent to the member's house being bought by someone else and used for a purpose the member doesn't like or want? Or is it the pension the only route being used because the client has no available cash from other sources with which to make it? These may be motivations to invest, but basically we need to understand them. Do they stack up commercially? Is it contingent upon anything else? And as I said, is it because there's no cash to use elsewhere? These are all considerations that we have to look at. So let's start to drill down now into the due diligence considerations around the broad investments. And we'll take a closer look at investments that might appear on a SIPP or SSAS provider's permitted investment list. Bear in mind that there's no HMRC permitted investment list anymore, so individual providers determine what's on their own investment lists. So I'm just going to put up on the slides here some examples of investments that might appear on a provider's investment list. And these, of course, relate to Dentons permitted investment list for SIPP. There's a whole range of different investments there that could be held within a bespoke SIPP. It could be straightforward quoted stocks and shares. It could be investment grade gold bullion, which we've seen a fair bit of happening so far this year. It could be loans to UK companies. It could be intellectual property or unregulated collectives. It's not an exhaustive list, and as I said, it will vary from provider to provider. Where required, though, rigorous due diligence would be undertaken by Dentons, specifically in this case, because this is our permitted investments list, and we do that due diligence free of charge and without obligation. And what we're looking to do is determine acceptability in principle. I stress acceptability in principle, and I'm not saying suitability. We determine acceptability in principle on any of these proposed investments. And some investments are far more complex than others and require skill and experience in determining acceptability in principle. And a classic example of that is unquoted shares. So if you're interested to see what our permitted investment list includes, because it's more comprehensive than the items I've just listed, the items I've listed and many more appear on our website under investments and permitted assets. So that's SIPP. How about SSAS then? Well, it's a broadly similar list for SSAS, so for SIPP rather, but a SSAS, as you may be aware, has an additional feature that enables SSAS trustees to loan money to a sponsoring employer. SIPPs are not allowed to lend to a connected party in any way, as you may know. SSASs, however, are allowed to lend to a sponsoring employer. So that's a key investment difference between SIPP and SSAS, and that's reflected in our permitted investment list. Another difference, though, you need to be aware of is that if it shares in the sponsoring employer that the trustees are looking to acquire, a self-investment restriction applies to SSAS that doesn't apply to SIPPs. And that investment restriction states that no more than 4.99% of the fund can be used to acquire shares in a sponsoring employer. Or if there are 4 separate sponsoring employers, just under 20% in total when you multiply the 4.99 by 4. That self-investment restriction does not apply to SIPPs, as I mentioned. However, SSAS members will almost always control the employer company or be controlling directors. So generally, the purchase of unquoted shares in the sponsoring employer generally falls foul of other due diligence criteria, in fact, whether it's SIPP or SSAS, because if it's a company that the member owns or controls, generally, it would fall foul of the due diligence requirements. And we do that work, as I said, for any advisor asking us to look at that for a client. One other thing to say as well, just watch out for some providers who say that it's 5% of the shares in the employer that can be acquired. That isn't the case. It's no more than 4.99% of the fund can be used to buy shares. Whatever percentage of the shares in the employer that buys, but it's not 5% of the shares in the employer that can be acquired here under the self-investment rules. Just be cautious of that. So we've mentioned loans. Let's look at loans in a bit more detail. You may have seen this slide before. Just as a reminder, in terms of SSAS loans to employers, the trustees are allowed to lend money to the employer or sponsoring employer, provided it's done on very specific terms set out by HMRC. I'll pick out a couple there. The maximum term is 5 years. And a key requirement is that the loan to the employer must be secured by a first legal charge over a suitable asset. When it comes to securing the lending, various forms of security could be put up by the borrower or another party, and I've put those loan security potential options up there. Dentons only allows security to take the form of UK commercial property or, subject to certain requirements, UK residential property, because there's more certainty of value in those in the event of the demise of the borrower compared to some of the other options. And in relation to some of the other options, they may not be enough to cover the outstanding loan plus interest, and any loan and interest that's not recovered becomes an unauthorised payment to the employer. And also what you've got to take care of is the fact that, for example, if it was plant and machinery, the trustees of the SSAS take possession of plant and machinery. Plant and machinery is generally stuff you can touch and move, tangible movable property, and it becomes taxable if and when the SSAS trustees take possession of it. So there's good reason for the loan security to be limited to ideally commercial property. We can speak to you separately about residential property and the special requirements around that if it's something that you're interested in. So we've looked at a number of different investments there. Clients maybe decided where he or she wishes to invest, and they might turn to you as their advisor to then facilitate it. What can the advisor do next to help the client? Well, when it comes to provider selections, advisors may be looking for providers that meet some or all of the following requirements. Is the provider that you're speaking to capable and competent of assessing acceptability in principle of the investment that you're looking at? Is it consistently service award winning as well, for example? Is it experienced in handling complex investments of the types that clients will put to you for consideration? Is there local business development support available to you for someone on the ground locally that will help gather the information and help to go through the due diligence process with the provider? And is the provider actually willing to conduct the necessary due diligence on the proposed investment? If they are, do they do it fee-free, or is there a fee for conducting the due diligence on behalf of your client? And in fact, does the provider's permitted investment list even allow the investment in the first place? And also, does it outline unacceptable assets to that provider, so you've got a clear indication in advance of whether an investment proposal will work or not? Also, does the provider that you're dealing with have a robust process to follow? For example, does it have specific investment questionnaires for a range of investments that clients will put to you? Does it have an investment committee that considers these matters in the round? And does it retain the services of an external due diligence specialist who can drill down even further into potential investments? So, having looked at all of these from the advisor's perspective, what then does the provider do in itself in terms of assessing acceptability in principle? Well, some of the things that a provider might be looking for in its due diligence work are the following. They might be looking to see if there's the presence or risk of taxable property arising through the investment that's being made. They might be looking to see whether the asset is income producing or not. Not necessarily always a problem if it isn't income producing, but if it's not income producing, that has its own specific considerations around it. The provider may be looking at the underlying complexity of the investment. For example, the jurisdiction in which it's based, the underlying structure of the investment, all those sorts of things. Is it fiendishly complicated to the point that as a provider, an experienced provider, it can't be understood? The provider may also be looking at potential liquidity, for example, to pay death benefits. Ultimately, a SIPP or SSAS is a retirement or death benefit scheme, and if the unexpected does happen, liquidity may need to be created sooner than expected to pay death benefits. Is the provider looking at the risk of unauthorised payments, be these member or employer unauthorised payments? Is it trying to assess the real underlying reason for the investment that's being made? Does it think about future marketability of that particular investment and how easy it will be to sell it, for example, again, to pay, for example, death benefits or pension commencement lump sum? Does it look at the size of the fund that the client's got and the amount to be invested and potentially compare it against its charging structure to see whether or not the two compare and stack up with each other? Does it look at pre-existing exposure to a particular investment that's put to it, or does it just wade through all the investments that's put to it, regardless of how much or how little exposure it's already got to that particular investment that the client wants to make? And does it look at the overall commercial property, the commerciality of the overall proposal? But once again, I'd stress that the provider should be assessing acceptability in principle and not commenting on or assessing suitability of the proposed investment. And I say that because that was covered in the recent Adams v Carey Pensions High Court judgment. And speaking of that judgment, that leads conveniently on to some updated due diligence considerations for advisors when selecting a SIPP or SSAS provider. You may be aware from a couple of years ago that there was a High Court case that was heard, I think it was in March 2018. We only recently heard the judgment. The judgment was handed down on the 18th of May 2020, so very recent. The judgment was handed down and we became aware of the outcome of that. You may also be aware, though, of another case involving another SIPP provider called Barclay Burke. Unfortunately, though, Barclay Burke SIPP Administration Limited went into administration a few weeks before the Court of Appeal hearing was scheduled to take place last October. There's therefore no judgment to refer to in that case. We can, however, look at the Adams v Carey Pensions case to see how it might impact on advisors' due diligence on SIPP providers, especially in the context of selecting a new provider or reviewing a provider you have exposure to currently for some of your clients. So I thought it would be useful just to give you some basic facts about the Adams v Carey Pensions case. The client in this case, Russell Adams, was a non-advised execution-only SIPP client of Carey Pensions. And he was introduced to Carey Pensions by a Spain-based unregulated introducer called CLP, or referred to as CLP in the judgment. So an unregulated introducer in Spain introduced Russell Adams to Carey Pensions. The client in that case invested into Store First storage pods, and the investment didn't perform as expected, as he expected. And it's important to say at this point that it wasn't viewed or seen at the time as a fraudulent or investment or a scam. It just didn't perform as Mr. Adams expected. And ultimately, he took Carey Pensions to court for his losses. The other thing to point out at this time is that the due diligence on the Carey investment wasn't the focus of the case. Due diligence on the investment in the Barclay Burke case was the focus of the case, but due diligence wasn't the underlying issue in the Adams v Carey Pensions case, just to be clear on that. Some other facts to go along with this. Mr. Adams actually received a £4,000 inducement for making the investment. He received that directly from the introducer in Spain, and in fact, it was actually paid into his wife's bank account. Carey Pensions claimed that they had no knowledge of those inducements being paid to clients of it, and in fact it terminated its introducer agreement with CLP as soon as it became aware of that happening. Mr. Adams signed declarations to confirm that he was aware that the investment he was going into at Store First storage pods was high risk and speculative in nature, and he signed various documents confirming that that was the case. And that was all clear, and that was important in the context of the court case. There were three actual threads to Mr. Adams' case against Carey Pensions. And we're not legal experts at all, but in basic terms, Mr. Adams' legal team presented three causes of action or strands to their case against Carey Pensions. In brief, these were, the first one, and the main one, was that there'd been a breach of Section 27 of the Financial Services and Markets Act 2000, and that the SIPP was actually unenforceable because of the actions of CLP, the introducer. So Mr. Adams' legal team claimed that the actual SIPP contract was unenforceable because of the actions of the introducer. The second strand to their case was the fact that Carey Pensions had breached Conduct of Business Sourcebook Rule 2.1.1R because it had failed to make him aware that the investment wasn't suitable, quote unquote, for him. So the claim was that Carey Pensions hadn't acted with honesty, fairness, or professionalism, thereby being in breach of COBS. And the third strand to the case was the fact that there was negligent investment advice provided by the unregulated introducer, for which Carey was liable as a result of, quote, joint venture, common design, or agreed common business model, unquote. So those were the strands to the case against Carey Pensions that were presented in court by Mr. Adams' legal team. In relation to the outcome, well, it's worth reading the judgment in full to fully understand the detail behind it, and it should be borne in mind that the case was decided on the very specific circumstances of it. But the judge dismissed all three claims. Mr. Adams testified in court that he went into the investment with his eyes open to the high risk and speculative nature of it. And he also stated that he went into it because of the inducement that was on offer, despite the high risk nature of it. He also acknowledged that the investment itself, it was the investment itself which caused the loss rather than the SIPP wrapper. And the judge made it clear that Carey Pensions could not legally have commented on suitability of the investment because it wasn't authorised or regulated to do so. There's two other quotes that I thought were interesting from the court judgment. One was that consumers should take responsibility for their own decisions, obviously particularly in an execution-only type environment that Mr. Adams found himself in. And also that high risk doesn't equate to unsuitable in relation to investments within SIPPs. So that was the outcome of the case. It may go to appeal. We don't know whether it will or it won't. Early indications are that it might be. But broad conclusions are impossible to draw, even if no appeal goes ahead. However, it's worth noting the judge's comments on consumers taking responsibility. And it's also worth noting that SIPP operators are not responsible for suitability of underlying investments when conducting due diligence. Also, that the SIPP wrapper itself is distinct from the underlying investment in terms of suitability. And as advisors, you'll be well aware of that. It was just interesting to see the High Court judge making a point of that in the judgment decision. So, some further due diligence considerations. What might be the implications for advisors and paraplanners around this then? Well, just be aware of the evolving case law affecting SIPP and SSAS providers. There's a growing body of case law now. There are FOS decisions, pensions ombudsman decisions that are all out there. It doesn't help in the case of things that there's a FOS decision, the outcome of which was made known after the Carey case. But anyway, be aware of the evolving case law affecting SIPP and SIPP providers. You might want to carefully consider which SIPP providers to recommend to clients based on history of that provider and history of the industry in general. You might want to understand the SIPP provider's previous and current business model, and that might include types of non-standard investment across its book of business. You can quiz SIPP providers about its exposure to non-standard investments. It's information it will have available, not necessarily published, but it will be available. You might want to look at amounts and concentrations of investment across its book as well. So has the SIPP provider, for example, taken large volumes of a particular type of investment into its book, and is it particularly exposed to a particular investment as a result of that? You may also want to look at where the SIPP provider's profit is derived from, and is it a sustainable business model that the provider operates? You may also wish to view its capital adequacy position. SIPP providers have to report capital adequacy to the FCA on a quarterly basis, so that calculation needs to be done, obviously quarterly as a minimum, and it's reported. And so you should be able to quiz a provider on its CapAd. And if you do struggle to get information on that from the provider, you may well ask them why it's making that information difficult to obtain. And finally, you may wish to ask the provider about its own investment due diligence process and how robust or otherwise are these. These are only pointers for paraplanners and advisors to consider, obviously, and your firm's compliance procedures will determine the due diligence factors that you need to take into account. So, if we just revisit those learning objectives briefly, we did have some particular learning objectives, which I hope the content has covered off to some extent. And hopefully it was what you wanted to know and a little bit more. However, if there's any topic you'd like us to cover in more detail at a future webinar, we'd be delighted to do that. So please do speak to your regional point of contact, whose details I'm now sharing on the screen for you. So we have a national team of sales professionals. Please do get in touch with them, either through the Q&A or directly with the person named on your screen there. Please do submit questions through the Q&A function, as I said. But just to conclude this morning's webinar, I'd just like to say thanks again once again for joining us, especially those who have joined us for the third time in a row now. The session has been recorded, so if you think a colleague would be interested in it, it will be available on our website shortly to view. CPD certificates will follow from your local Dentons point of contact in due course, as you may have experienced already with us with the previous webinars. Please do stay safe as ever. Thank you again, and good morning.